Hi there, welcome to kneppyinvests. 2 years ago, or just over 2 years ago, a company called Swoop listed on the ASX. This company is an internet and telecommunications provider. And in fact, I did change my internet provider about 6 months ago, and I had a look at Swoop. In fact, I had a look at quite a few companies on the ASX, including Australian Broadband, Swoop, and that might have been one or two other companies in there. What's our other company? Superloop. I also looked at them. Now, the share price of Swoop has come down a lot since they listed. And this company is operating cash flow positive. And if they can hit that very important inflection point of becoming free cash flow positive, now this company does spend a lot of money on capital expenditure to build out their infrastructure. I think this company will be looking even more interesting than it is right now. However, in saying that, the share price is in a well-defined long-term and even short-term downtrend. Now, a few facts in regards to Swoop. As I've already mentioned, they just celebrated their 2-year anniversary on the ASX. They listed on the 27th of May, 2021. And during this period, like after or post COVID-19, we had a flurry of companies list on the ASX, and Swoop was one of them because it was good times, not like we're seeing now. Bad times, companies don't list on the ASX, particularly where we're in a threat of recession. Current CEO of Swoop is Alex West. And I do believe, I'm just having a look at his history, I'm pretty sure he has had a history in this sector. In fact, he was the group CEO at Superloop. And it's really interesting to see their board. So the non-executive chairman is James Spenceley, and he was the founder and CEO of Vocus Communications. And that company was taken out, is no longer on the ASX. So he's also the chairman of Airtasker, a non-executive director of Kogan and Think Childcare. So he has, he's doing a lot at this point in time, but he does have that experience in this area. So that's another reason to like Swoop. And another reason to like Swoop is the largest shareholder. Now, most people probably haven't heard of Tatarang Ventures. They own 15.4% of Swoop. And who is the owner of Tatarang Ventures? It is none other than Andrew Forrest, or Twiggy. Yeah, that guy from Fortescue. So he's put a lot of money into Swoop, 15.4% holding in this company. Now, let's have a look at the market cap of Swoop. Now, just after they listed on the ASX, the share price did go on a nice run. In fact, the share price went to $2.46. At that price and at that time, the market cap of this company was 357 million. Last time I did a video on this company 1 year ago, share price had fallen to 50 cents, which means the market cap was 73 million. And because they did do a pretty big capital raising, even though the share price has fallen by more than half since then, down to 20.5 cents, the market cap has only dropped from 73 million to 43 million. Yet that does seem fairly low for a company like this, particularly when the market was willing to pay $2.46 or willing to value this company at 357 million only not quite 2 years ago. We'll call that 21 months ago. So there is possible value here, particularly if they can prove to the market they can become free cash flow positive. That's the inflection point I want to see from Swoop. And the ticker for this company is SWP. Before we have a look at the March quarter results for Swoop, so one of the main catalysts for me doing this video was not only their 2-year anniversary on the ASX, it was also their March quarter results. So what I'm going to do now is look at the March quarter results 1 year ago, and just to see, just compared to these quarter results, just to see how the company is performing, how the company is growing, that sort of thing. So 1 year ago, this company was operating cash flow positive. So they're not having a problem generating cash in the operations. Their biggest problem is they are spending a lot of money on capital expenditure, and that capital expenditure is all about the infrastructure. So 1 year ago, receipts of customers up to almost $14 million, and they were operating cash flow positive, 933,000. But they did spend $2.9 million on capital expenditure, which means they were free cash flow negative by over $2 million in this one quarter. But they did have a lot of cash, $40.5 million of cash, no debt, which means the enterprise value at this point in time was only $33 million. So let's see how Swoop has performed over the past year. Now, the company has made an acquisition, and that could have led to a bit of an increase in receipts to customers. So not all this increase in receipts is because of organic reasons. And I want to see a lot of organic growth for these companies. I don't like to see companies growing through acquisitions. Now, a few acquisitions here and there is okay, but there are a lot of roll-up stories on the ASX, and I'm not a big fan of those companies. If you don't know what roll-up means, it means those companies that just keep on buying other companies to grow their revenue. Perfect example of that is Tesseract. Another example of that is G8 Education. And G8 Education about 7 or 8 years ago had that model, roll-up model, and then they could no longer buy any more childcare centers, and you saw a significant decrease in the valuation of that company. But for the March quarter, Swoop had receipts from customers of 21.6 million. For the 9 months to date for this year, receipts are up to 61.2 million. And the company was operating cash flow positive by $2.5 million in this quarter and $9.8 million for the first 9 months of the year. But again, that's operating cash flow. It's not free cash flow. And in this quarter, they've actually ramped up their spending on capital expenditure, 3.3 million, which means the company was free cash flow negative by almost $1 million. Now, the cash on hand has fallen to 19.7 million. They did a pretty big capital raising. They also made an acquisition. And the reason why the cash on hand has fallen is because they are burning through cash and because the acquisition. And not only that, they've actually increased their debt. In fact, they now have $19.1 million of debt, which means the enterprise value is just around about $40 million. So even though the market cap of this company has fallen significantly from last year, the enterprise value is actually higher. So in a way, this company is valued higher than it was 1 year ago, even though the share price has more than halved. But in saying that, this company has no problems or has had no problems growing the receipts through time. In fact, receipts have grown from 6.2 million to 21.6 million. I would like to see a breakdown of receipts through the increase in receipts through acquisitions versus organic increases. They haven't really done that. But the main thing here is receipts are growing through time. The other thing I like to see is revenue per share growing through time. I haven't had a look at that. And I might have a look at that when or if this company hits that very important inflection point of becoming free cash flow positive. In the March quarter, as I mentioned, they're still $1 million off from reaching that point. So where is all this money going, all this capital expenditure? So this is sort of what they presented about 1 year ago in regards to the allocation of funds, sort of like a capital allocation. And the majority of their funds is going to fixed wireless and core network expenditure and deployment across Sydney, Melbourne, and key regional areas and Perth. So sort of building out their infrastructure, which is very important for these types of companies. Not sure how long they still have to build out the infrastructure. It could last a few more years, 5 years or 10 years, but still I'd like to see this company reach becoming or retrieve that very important inflection point of becoming free cash flow positive and still be able to build out their infrastructure. If they can achieve that, this company, again, is looking really interesting. But do you know what's not looking interesting for Swoop? And that is the chart. This is the chart of the company from when they listed on the ASX. And in the second half of 2021, up to the share price reaching its high in September, that was at $2.46. The share price of this company went on an absolute tear from about 87.5 cents to that high. So tripling in the share price in a fairly short period of time. But since that high in September 2021, the share price has been in a well-defined downtrend. It went through a really important support level in May of last year. That's at a share price of 87.5 cents. And that was the previous lows. And you can see a bounce off those lows back in March. So a few months before the share price fell through that support level. And the share price just keeps on falling. Now, I'll look at a zoomed in version of the chart because I do have two areas here. So just looking at something a little bit different when I'm looking at charts, and the two sort of two areas I have here, the shaded in areas, is the long-term trend and the short-term trend. And I'll talk about that in the next slide when we look at the zoomed in version of the chart. So this is the zoomed in version of the previous chart going back to April of last year. And what I've done here in these charts is just looking at two sort of trends. The first trend is the trend on top here, which is the shaded in red area, and that is the long-term trend. The bottom shaded in area is the shorter term trend. So what I'm looking for with Swoop is a shift in the short-term trend. That will come first. And the short-term trend is the shorter-term traders, are those who are probably willing to hold Swoop for a shorter period of time. But I'm really interested in those longer-term holders who want to take a position in a company because they see value. That is the long-term trend. So ideally, I want to see both trends going up. But the first shift you will see is when that short-term trend for Swoop goes from negative to positive, but it's still negative, and this is a well-defined long-term and short-term down trend. No idea how much further the share price of this company has to fall, but I am thinking as it does fall further and further, it does become more attractive in terms of valuation, particularly if that company can become free cash flow positive. And I think that's what the market is waiting for. And if that company can prove they are free cash flow positive, maybe not just one quarter, but a few quarters, I think until then, the share price could either drop a little bit further from here or at the very least go sideways and just consolidate. So that's the first thing I want to see is a bit of consolidation before I even get interested in taking a position in this company. That's all I have for this company update on Swoop. 2 years on the ASX. Unfortunately, share price has never been lower. Who knows how much further the share price has to fall for Swoop, but the company is operating cash flow positive. In fact, in the first 9 months of the year, they were operating cash flow positive by almost $10 million. But they are spending a lot of money on infrastructure, building out the infrastructure, which means they're still burning through cash. And they do have a little bit of debt now. And I'm always wary of companies of this size that have debt because eventually they will have to pay that debt. So if you have any questions about Swoop, maybe any other companies in this sector, I'd love to hear your thoughts. So leave those thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.